Hey everyone, welcome to my Year 12 BOM financial ratios revision video. I'll be going through 6 different financial ratios through profitability, liquidity, gearing, and efficiency ratios. I'll also touch on break-even point towards the end and how to calculate break-even points with desired profits. You'll find all of the timed marks in the description below if you want to skip through to any specific ratios that you're not sure of. So we'll get stuck straight into the video now. The first ratio that we're looking at is the gross profit ratio. This is a profitability ratio that tells us how well the business is doing, turning its sales into gross profit. The gross profit figure as well as the net sales figure are both found in the income statement. This ratio tells us that for every $1 of sales, the business is making how many cents into gross profit. To improve this figure, because it's only so very limited as to what's calculated within it, it's literally sales and cost of goods sold. The only ways to improve it is by decreasing cost of goods sold or increasing sale prices or volume. So if you put a higher markup on your products, despite potentially losing some sales volume, you might make that up in revenue because you've set a higher price. Cost of goods sold can be defined as pretty much the cost to the business of what is required to get the product into a saleable condition. So that involves buying the stock from a supplier, transporting it, storing it, the cost of pretty much getting it onto the shelf ready for sale. So let's start by calculating the gross profit the gross profit ratio for 2015. So to do that, we need to know what the gross profit ratio is. So gross profit ratio is gross profit over net sales. So for every $1 of net sales that we make, the result of this calculation is how many cents of gross profit we're making. So to do that, we will go to the income statement where gross profit and net sales are found. So we have our gross profit figure for 2015 is $204,892 divided by the net sales figure, the total sales, both cash and credit combined, is $354,892. which equals, grab our scientific calculator, do 204,892 divided by 354,892, which gives us 0.5773. So to get that into a percentage, times that by 100 is 57.73%. 57.73%. And then we'll do the same for 2016. So 2016, once again, gross profit divided by net sales. Just fill in the details there. 2016 is 156,156,963 divided by net sales for 2016, 321,963, which, plugging into our calculator, 156,963 divided by 321,963 equals 48 38.75%. Fill that in, 48 point. So what we can tell from this here now, looking at these two figures, in 2015 we were well above industry average, which is good. 2016 we're just under industry average, not as good, but it's still not too bad. Figuring out why the gross profit ratio is the way that it is now, we need to then go back and look at the income statement. So gross profit ratio is gross profit divided by net sales. So we'll look at those figures and see what's happened. So year on year, our sales have actually decreased, but our cost of goods sold has increased. So despite selling less, it's costing us more to do so. So one of the potential issues could be a change of supplier, charging more money for per unit for cost. Combined with decreased sales volume, whether that could be from a decrease in advertising expenses, a $300 decrease in advertising expenses may have led to the drop in sales or contributed to the drop in sales. This can all be ascertained from looking at the income statement and helping piece together why the trend is the way that it is. The next ratio that we're looking at is net profit ratio. Once again, another profitability ratio, but rather than just gross profit, which is sales minus cost of goods sold, net profit is calculated by subtracting all expenses for the business from the gross profit figure. This ratio tells us for every $1 of sales, the business is making X cents of net profit. Net profit is what is taken home by the owner, what they can put in their pockets. So the higher the percentage of this ratio, the better. There is no too high per se, such as in the case of current ratio. So the higher the net profit ratio, the better. The data can be found in the income statement, as this has all got to do with revenue and expenses. You can improve the net profit ratio by decreasing some of your expenses, such as wages, utility bills, advertising or something, to help increase net profit, or increasing your sales price or volume similar to the gross profit ratio. So increasing your markup on your products, or easier said than done, but selling more products. Now we will calculate the net profit ratio for Tim's Paint Palace. So to do so, we'll start off with writing down what it is. Net profit ratio equals net profit divided by net sales. So now that we've written that down, we know what we're looking for when we go to the income statement. So turning back over, looking at the income statement for 2015 to start off with, we will do net profit. So 129,776. 2015, 129,776 divided by the net sales for the year is 354,892, which equals, grab our scientific calculator, 129,776 divided by 354,892. It's 36.57. 36.57%. So for every $1 of sales, we're making 36.57 cents towards net profit. So I'll do the same for 2016. So the 2016 net profit is 86,000. Oof, taken a bit of a slump from the previous year. So 86,963 divided by net sales, which is 321,963. Get our calculator out. We'll go 86963. Whoop. 86963 divided by 321,963 equals 0.2701, so 27.01%. So in 2016, for every $1 of sales, we're making 27.01 cents to our net profit. The return on owner's equity ratio tells us for every $1 of owner's equity, so the owner's investment into the business is making X cents of net profit. What this ratio is good for is if an owner is potentially looking to invest their money elsewhere. If they're getting a 20% return on their dollar in, say, an investment property, whereas they're getting a 40 or 50% return on their dollar from this business, it would be worthwhile sticking with the business and investing their money within the business. However, on the flip side, if the business was only giving a 15% return on owner's equity, and they had a better option, maybe a 25 or 30% return on investment through something else, whether that's bonds or investment properties or something, then it might be worthwhile actually investing their money elsewhere and maybe folding the business. So the figures within the return on owner's equity ratio can be found. The net profit can be found in the income statement and the owner's equity in the balance sheet. To improve this ratio, you can either improve your net profit through increasing sales, decreasing expenses, or investing less capital in the business. So if you invest less but are still able to make good profit, then the return on your dollar will actually be greater. So now we're looking at the rate of return on equity ratio, or return on equity ratio, ROE. So first off, ROE equals net profit divided by owner's equity. So now we've got two figures from two different statements. The net profit can be found in the income statement, whereas owner's equity will be found in the balance sheet. We'll start off with 2015, turning over, finding our net profit figure for 2015, which is 129,776 divided by owner's equity. So to find owner's equity, we must go down the bottom of the balance sheet and find total owner's equity. So for 2015, it is 178,140. So now we'll do that calculation on our scientific calculator. So 129,776 divided by 178,140 equals 72.85%. So for every $1 of owner's equity, we are making 72.85 cents of net profit, which is actually very good compared to some of the other options that someone could use to invest their money in. So now we'll do it for 2016. So 2016, the net profit figure is 86963. 86963 divided by, we'll go down, total owner's equity for 2016 is 265,103. On our calculator, we'll do that. 86963 divided by 265,103 equals 32.80%. So now this figure has significantly dropped. You can have a look back, try and figure out why that may be the case. So we've got, well, first off, net profit took a huge dive. The reduction in net sales, as well as the increase in cost of goods sold, really hurt the business in 2016. But as for total owner's equity, the owner, you can see here, actually put in $130,000 or $129,000 of their own money into the business. They injected that much into the business. So now, the money that the owner has invested isn't going as far as what it was before. Before, they'd only invested a total of $178,000, and now they've invested a total of $265,000, and they're making less profit on that. The current ratio is a liquidity ratio that tells us how ready our business is to pay off our debts. So this is calculated by dividing our current assets over current liabilities. It's nice that they have current everywhere. It helps us remember this formula. Rather than it being a percentage ratio, it's a ratio of X to 1. So for every X dollars of assets, we've got $1 of liabilities. Or, put it differently, for every $1 of current liabilities, the business has X dollars of current assets. This tells us, so if all of our current liabilities, so all of our current debts that we need to pay within the next 12 months, if they all come a knocking, they all knock on our door saying, hey, give us our money. How good a position is the business to be able to deal with that? If the ratio is, say, 1 or 1.5 to 1, or 1 to 1.5, that means that for every dollar of debt, we've only got $1 or $1.50 of assets. So if we need to spend all our money, we may not have a lot of assets left over to continue on with the business. A ratio of 2 to 1 is ideal. So for we have $2 of assets for every $1 of liabilities. Both of these figures can be found in the balance sheet. And to improve this figure, if it is too low, say if it's between 1 to 1.5 or 2, you can either reduce your current liabilities by using your cash to pay off some of those debts, or increasing your current assets if it's too low. But what can also happen is the current ratio actually being too high. So if the current ratio is sitting at, say, probably anything above 3, it means that you're not utilizing your current assets to help grow the business. So if the current ratio is above 3, you'll be looking to spend your current assets to help improve the business. Now looking at current ratio, the current ratio is the ability for the business to meet its debts in the short term. So it if all of our current liabilities, so all of our current debts that we're expecting to pay within 12 months, if they all turn around and say, give us our money now, what is the business's ability to be able to meet those demands? Will they barely scrape in with $1 of assets for every $1 of debt? Or will they have a little bit of comfort, ideally having around $2 of assets for every $1 of debt? Some of the issues that can be seen is if you have too many assets and not enough debt, it means that you're a little too safe, and you can be better utilizing your assets to help make you money, help make you profit. So to calculate current ratio, first off, we write down, so current ratio equals current assets over current liabilities. The good thing about this ratio is that the name kind of gives away what you're looking at. Current assets, current liabilities. All of assets and liabilities are found within the balance sheet. So we'll turn over to the balance sheet, have a look at that. So we'll look up here. We've got total of our current assets, which is, we'll go for 2000, we'll stick with the 2015, is 253,140 divided by our current liabilities. So our total current liabilities is 85,000. We'll plug that into our trusty calculator. 253,140 divided by 85,000 equals 297 equals 2.98. So we're almost sitting at 3.0 for 2015, almost, which is probably a touch on the high side. We could probably better utilize some of our current assets to help us make money. We'll then do the same for 2016. So the current assets figure for 2016 is 364,450 divided by current liabilities, 99,347, which equals trusty calculator, 364,450 divided by 99,347 equals 3.67. So what these figures tell us is for every $1 of assets in 2015, for every $1 of liabilities, what's on the bottom, for every $1 of current liabilities, we've got $2.98 of current assets. In 2016, for every $1 of current liabilities, we've got $3.67 of current assets. So that means, so we're not concerned about us not being able to meet debts. But now we need to figure out if the business can actually better use these assets to help reduce this number down to around 2, but use these assets to help grow the business. So looking at the current assets on the balance sheet, we can actually see that Tim's Paint Palace has got a lot of cash just sitting there. Although it's nice to have cash at bank in case of emergencies, having too much cash at bank means that we're underutilizing that asset to help us make profit. So some things that Tim could do to invest his cash could be to either help pay off some of his debts or to improve on processes, maybe expand the business to a larger location. But given that his sales are actually dropping, that may not be the best move. So it might be worth spending some of that cash to help get rid of some of his debts, or maybe increase advertising. Try and help get those sales figures up to improve the profit figures. if a current ratio is too high, which is usually probably higher than 2.5 to 3, you need to start looking at where else they can invest their current assets to help improve the business. The equity ratio is a gearing ratio. So gearing is telling us how much of the business's assets are funded either internally or from external debt. So this one here is telling us, because it is total owner's equity over total assets, it's telling us for every $1 of assets, the owner has financed X amount of cents. The two ways to fund assets are either through internal debt, so owner's equity, or through external debt or liabilities. If this equity ratio results as, say, 40 or 50% for owner's equity over assets, it means that for every $1 of assets, the owner has financed 40 cents of that, which means 60% of our assets are financed externally. This, for some businesses, can be a large risk. Businesses which have a rather secure revenue stream, such as a supermarket chain or something which are selling necessary items for life, you would think that people would buy those products regardless of what's going on in the world, in the economy. Whereas if you were opening a luxury item store, you probably wouldn't want a lot of your debt coming from external sources, because if a financial downturn happens and people don't have as much expendable cash, then they may not fork out on getting some luxury items. And your creditors, the people who you owe money to, they don't really care about how your business is going. They want their money. So you can try and have a whinge and say that people aren't buying your stuff because it's a financial downturn. But in the end, the people you owe money to will come knocking on your door to get that money back. So having too much of your assets funded from external sources can be a little bit of a risk if your revenue stream dries up and you can't make the repayments. The figures in this ratio can be both found in the balance sheet, which is nice. If you need to improve this ratio, the owner can either invest more money into the firm to buy their assets, increasing the percentage of the owner's investment into the assets, or reducing your reliance on external debts to finance assets. So now we're looking at the equity ratio. So the equity ratio tells us how much of the company's assets has been financed by the owner. This is a gearing ratio. So gearing tells us a lot about the risk of a business and how much of its assets are either financed from external or internal debts, so liabilities or owner's equity. So to do this, we start off by writing down the formula. So equity ratio is total owner's equity over total assets. So for every $1 of assets, X cents were financed by the owner. So for 2015, we'll have a look. Total owner's equity and total assets are both found in the balance sheet. So total owner's equity down the bottom is 178,140 divided by total assets. 373,140. Trusty calculator. 178,140 divided by 373,140. Times it by 100 to get our percentage equals 47.74%. So for every $1 of assets, 47.74 cents were funded by the owner. In 2016, the figure was total owner's equity is 265,103 divided by total assets 494,450. 265,103 divided by 494,450 equals 0.5 or 53.62%. So for every $1 of assets in 2015, 47.74% were funded by the owner, and for every $1 of assets in 2016, 53.62 cents were funded by the owner. The reason why, for a small business in particular, the reason why having a higher equity ratio is better for smaller businesses is because if all of your debts come knocking, or if the business folds, the owner is really the one who loses out. So rather than, if this figure was down at say 20%, so 80% of the assets were funded by external debt, it means there's a lot of risk that all the external debt could come knocking and take all your assets. Whereas having a higher equity ratio, so 60%, means only 40% of the assets are funded from a loan or a liability, which is less risk if they come knocking. The accounts receivable turnover ratio has kind of got two steps to calculating this ratio. The first step is dividing credit sales by accounts receivable. The result from doing this, you then divide into 365. So 365 divided by the result of credit sales over accounts receivable will give you how many days, or X amount of days, which can be interpreted into the number of days that it takes for you to turn your credit sales into cash at bank. So it takes X days for credit sales to turn to cash in bank. We can find these figures. Credit sales, being a revenue item, will be found in the income statement, and accounts receivable, an asset, and accounts receivable, which may also appear as debtors on some balance sheets, is the money that is owed to us, whether that is somebody purchasing something, we give them an invoice and they just haven't paid that yet. So that is accounts receivable. They're an asset. We expect to get financial benefit from them within the next 12 months. Or the way that you can help improve your accounts receivable numbers is actually employing someone or doing it yourself, but to manage your accounts receivable, whether that is hassling the people who owe you money a little bit more than you might usually to help get them to pay on time, or offering incentives on your invoices that if they pay within X amount of days, that could be set by you, what you would like. If you would like them to pay within 30 days, you could have a term on your invoice that is, if you pay within 30 days, they get a 5% discount. It doesn't seem like much, but what that can do, despite maybe taking a little bit of chunk out of the cash that you actually receive, being able to receive your cash within 30 days versus say 60, 90, 100 days, means that you can utilize that cash to either pay off your debts or expand your business. Calculating rate of return of accounts receivable, or accounts receivable turnover, can help us determine how many days it takes for us to turn our credit sales into cash at bank. So this calculation has got two steps to it. So the first step, so accounts receivable turnover. The first step is determining our accounts receivable figure. So we have credit sales divided by accounts receivable. This is the first step. So step 1 is credit sales divided by accounts receivable. We don't do cash sales because cash sales have got nothing to do with accounts receivable. Accounts receivables are created from credit sales. So for step 1 for 2015, we'll go in here. Credit sales are found in the income statement as it is a revenue item. So the credit, you can even use a ruler to find the line if you're having troubles. So the credit sales figure for 2015 is 157,680. And then accounts receivable, because accounts receivable as an asset, accounts receivable is the money that we're expecting to be paid from other people. We'll go down to the balance sheet. We'll have a look at accounts receivable line. So 45620, 45620. Whip out our trusty calculator. 157,680 divided by 45620 equals 3.46. And then what we do from here is divide 365, as in 365 days in a year, divided by 3.46, the result of this credit sales divided by accounts receivable. So this is 365 divided by answer equals 105.6 days. So for this business in 2015, it took 106 days or 105.6 days to turn our credit sales into cash at bank. So we'll fill that number out here. So we've got rate of return of accounts, 105.6. Oof, compared to the industry average, that's pretty shocking. Let's see if they get any better in 2016. So the first step is credit sales divided by accounts receivable. So credit sales for 2016 is 186,190 divided by accounts receivable for 2016 is 96870. Calculator out. 186,190 divided by 96870. Ooh, this is not going to be pretty. It was 1.92. 365 divided by 1.92 equals 365 divided by answer 189.9. This is getting messy. This is getting very messy very quickly. So now it's taking 190 days. It's taking 190 days to turn our credit sales into cash at bank. Ways to increase or make this number better. You can't really do too much to within the business, as in increasing sales or whatnot. The one thing that you would need to do is to enlist or employ someone that can help control your accounts receivable. Whether that is a very stern person that doesn't mind sending an email or making a phone call to hassle people to get them to pay on time, or it is purely just keeping on top of your accounts and making sure that you send timely invoices and maybe even encourage maybe even encourage your debtors or your accounts receivable that if they pay within a certain amount of days, they get a slight discount. That slight discount may mean you lose out on a little bit of revenue, but it's better to have that money in cash for you to grow your business rather than relying on other sources to help keep that cash flow coming in.